Hello, this is Bill Moreland with Bankreg Data. Today I'm going to take a look at Sandy Spring Bank. And little did I know that Sandy Spring Bank is actually now part of Atlantic Union. And that announcement was, essentially made right here, which was October 24th, or excuse me, October 2024, Monday, October 21st, 2024, excuse me. Um, I didn't realize that. Shows you how on top of things I am. The reason I picked Sandy Spring is we're sitting at April 22nd. And as of this morning, basically 1,057 banks have filed call reports. So what I always like to do is take a quick look, come in, who are the guys that have filed, cycle down, start taking a look at the publicly traded banks. Texas Capital was a couple days ago. They're a unique animal. They're a whole nother animal. But Sandy Spring was the bank I wanted to take a quick look at. And then I basically went out to their website and I saw that they got sold. So the timing of this is October 21st to 2024, they announced it. So after Q3 call reports, but they were probably negotiating at 9:30. Then you have 12:31 call report, and now the entity is combined basically as of April 1st, 2025. So understand this is going 2 call reports back in time, potentially 3. So an interesting exercise that I didn't actually anticipate. But let's take a quick look. We can see that they were anticipating, right? They were increasing that assets 13.88, 14.00, to 14.38, and then they have shrunk and now they're down substantially. So that 13.77 actually takes them all the way back to almost 3 years ago. And the staffing is pretty similar at that as well. But the beauty of acquisition / merger is efficiency. So we know that those numbers will continue to go down. Let's take a look at the 3 tools that we have. The threshold alerts at the bottom. We're firing a high CRE concentration ratio. This is in Maryland. Not necessarily going to be Miami and New Jersey and New York and Chicago where they're allowed to run high, but not so alarmingly high. And yeah, right. So look at this. Our experience has been that banks are typically very much under scrutiny once they get to that 360, 370 range. And you can see that here. They were bouncing below that 350 for a long time coming down here. They got upwards of 370, 372. And then since that time frame, you can see that they have been kind of shrinking that book. At the same time, they've been growing their tier 1 capital and their provision, or excuse me, their allowance. So not at all surprising that that number's coming down. It does mean that they have a lot of exposure to commercial real estate, but there's nothing here that's alarming. But remember that 370. We are seeing very high construction NPLs, which, by the way, construction is part of the CRE concentration ratio. So that's part of the reason people are worried about it, is because a lot of growth in that industry, which we're seeing 7-Eleven upwards to 900. So that's $190 million of growth in a year and a half. And now they have some delinquencies, right? And the reason this triggers is that's a very high delinquency rate, 7.75%. Were they getting early stage? Yeah. So you do a lot of underwriting. The portfolio grows real quick. You wait a year or 2, and then you start to see delinquencies, usually within 18 to 24 months. Not that you can't have fast growth without it, but typically portfolios that start to get into trouble are more often than not, faster growing portfolios. So we see why, right? A couple of issues: overexposure to commercial real estate, a lot of land loans, and then lo and behold, a lot of charge-offs. But understand that they're potentially cleaning up the book pre-acquisition, right? So the timing of this is they're probably trying to clean the book up going into the April 1st consolidation. We'll continue to look, though, because they still have high NPLs, even though they are taking large charge-offs. Cash is low. That's going to be a liquidity thing for me. Loans to core is high. And they have low net interest margin. And I think I have a pretty good idea why that is. And we'll come back to that. Century is that second set of analytics. There's a whole separate tab for it. And we've already identified the construction portfolio as becoming more problematic. Right there is non-performing loans, and we can see it went from a couple million up to 31 million, up to 67. Farmland, interesting, has a little bit of delinquency, probably one or two loans. But you see they're taking a lot of construction charge-offs too, and then multifamily charge-offs, and then non-owner charge-offs, and then C&I. So very clearly they're purging charge-offs going into the acquisition. So I'm going to guess that in Q2, Sandy Spring will no longer be filing a call report. It'll get consolidated down. So this is kind of our last glimpse to how that management team or the new management team is trying to manage that book. But it also looks like they're doing a lot of construction, TDR, commercial real estate, TDR. TDR is loan modifications. We also see that after several quarters of shrinking FHLB advances, they jumped up 150 million. So why, right? So that's one of the first questions. And I'm going to guess, that they lost some core deposits. So there's a lot going on here. Nobody cared about deposits because we printed $5 trillion. And then Silicon Valley Bank happened, and we cared about deposits again because rates started to become problematic. And so what Sandy Spring started to do, and this is why we know their net interest margin, that's one of the first clues, is they were probably paying up for deposits. Yeah, right? So red means they're significantly higher blended across the board on checking, savings, CDs, and broker deposits. It's all lumped together. And they got upwards of 3.66%. And it was doing a good job of bringing deposits in. And then they started to drop rates, but notice how quickly they dropped. All the other similar sized banks dropped 14 basis points. They dropped 27. So they were way more aggressive in dropping rates. And then they dropped even further. This number is still incomplete because we only got about 25% of the banks that filed call reports. Sandy Spring is the second largest bank that has filed through the 21st. So part of the reason they're losing core deposits is going to be because they were very quick to lower rates. Part of it is because the acquisition of Atlantic Union, and I imagine there's always a runoff of 7 to 15% of deposits with an acquisition. That's just part of it, especially if they're in the same footprint. People don't want to do business with Atlantic Union. That's why they were doing business with Sandy Spring. Now, hey, more choices, efficiencies, and they're right back to doing business. So part of the reason they have a challenged net interest margin is that their funding costs, and actually they're not brutal across the board, but that's going to be, what else do they have here? Other borrowed money. All right, so there's BTFP money, but that was well over a year and a half ago. There's brokered deposits, was working its way down. And what else do they got going on here? Let's take a look. FHLB advances, securities repurchases, so that's part of it. So their total deposit expense is coming down and is high, but they're also challenged, right? If we come back here, we know that their net interest margin is challenged, and we see it again right there. So what do we see in the tear sheet? We see a lot of asset quality problems. We see a lot of charge-off problems. They're not reserved. They're in the bottom 20%. Even after taking all those charge-offs and having high provision, they're still not reserved. So we'll come back to that. But notice a couple things here. Their net interest margin is low, and part of that is because their yield on their loan portfolio is very low. Part of the reason the yield on their loan portfolio is very low, bottom 20%, is because they have a lot of adjustable rate mortgages. So let's look at this. There's something going on here. I don't really fully understand it. Typically when you see a jump up like this, it's because of an acquisition, but we're not seeing acquisitions. It could be because they had a classification issue in the call report. It could be because they basically had smaller term mortgages. And then they refinance them into adjustable rate. So I don't really fully understand that big increase from 345 to 960 to 1.02 billion. But for purposes of where they're challenged is 61% of their mortgages are adjustable rate. And what that does for them is right here. So this is yield, which is interest income. And you can see on 1 to 4, it's only 3.6%. So they're going to be challenged on net interest margin to the extent that they do a lot of mortgage lending and it is adjustable rate, a big chunk, 60%. So it's the second largest portfolio, $2 billion, 17% of their book. So their net interest margin is challenged. And the more they lower rates, the more it's going to drive core deposits away, which means the more they have to get, right? So a merger makes sense for a lot of reasons because that model's a little bit broke for them is they have to rely either on higher funding costs or more FHLB advances. So I could see the motivation behind selling, and I don't know what they sold it at. Was it generous, not generous? But I'm wondering, it probably shouldn't have been too generous because we can see that they had a deteriorating delinquency problem. So this bank had a net interest margin problem. I can see that income and expense, net interest margin. I'm going to go to tax equivalent. I'm going to be generous and do average earning assets. So the number was going down, 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 down. And then it has inverted and started to come back up a little bit as rates have gone down, right? But pre-tax net operating, this bank was having a problem, right? So they were doing very well when the government printed lots of money and funding costs were very cheap. But as soon as those funding costs started going up, their net interest margin and then their pre-tax started to get challenged. These couple of quarters right here are, remember what I said, the 2 quarters in Q4 and Q1 were post-merger announcement. And then post-acquisition is just April 1st where it's all going to get consolidated. So we're probably looking to last. So this 26 million is actually interesting because it looks like a big loss. Is it net charge-offs? All right. So the problem they have in Q1 is net charge-offs. That's why their Q1 number is very, very low. Why? They don't have any charge-offs. And what it is non-interest expense. And you're seeing an enormous increase. And almost always it's going to be goodwill, right? So basically this is an accounting loss where they're basically reevaluating what's on the books, cleaning stuff up for that merger. So not really it's more of a paper loss. But we do know that this bank, as it's currently structured with a low net interest margin, marginally higher funding costs, and a lot of adjustable rate mortgages dragging down their yield, their securities book is small, 9.47. Man, they carry very little cash. Always bothered to see a bank sub 2, sub 3. Their securities, appreciation, depreciation. This is the mark-to-market losses. It's about 90 cents on the dollar, which actually is not bad. As a percent of their capital, it's only 8-9%. So they're fine. They're fine on all that stuff. What's hurting this bank is their book is deteriorating, their loan book. So what you're seeing is a lot of delinquencies increasing and restructured debt is increasing. And they took a mountain of charge-offs. So let's cycle through. We know this. We saw this according to Century. They took charge-offs in a lot of portfolios. A ton. All brand new. Taking tons of charge-offs. So what they're doing is they're cleaning up this book and it'll disappear most likely. We won't see Sandy Springs anymore. We may see one more quarter, but I bet they get consolidated on Atlantic Union in Q2. But even with all those charge-offs, aggregate delinquencies are only down 114, from 125 to 114, which isn't much considering how much. So they're still running a really high relative non-performing loan rate. Once again, the peer number's wrong. They're one of the few big banks to file. As we get more bigger banks filing in that 13, $14 billion range, the peer number will come back up to the 75, 80, 82 basis points likely. So it's not that they're dramatically worse, but they're still very high considering all the charge-offs they're taking. And if you look, all right, so a big drop off in non-performing, non-owner, which is their largest. But if we come over and take a look at this, something that caught my eye a little bit earlier is they're doing a lot of modifications. So they're reporting over here, well, look at that, early stage delinquencies. That could be one guy, right, that's considerably late, early stage, 1 to 3 months, hasn't gone all the way to late stage. NPLs are down, but that's because the big charge off. So that you see how it works its way through. But total delinquencies are sitting at 32 million and 94 basis points. But if I come over here on the same exact portfolio and I look at the performing mods, these are separate buckets. The reason you put it on performing, and it's not performing, it's the payment's been lowered. It was going to have delinquency issues. We proactively lowered the payment, and he's making payments. The borrower is making payments. They call it performing, but it's a misnomer. It means it's doing what it was promised that it would do at a lower payment level. But you can see they're still sitting at $16.5 million, and that number kind of fluctuates. But what catches your eye over here is there's the 32 and the 94. There's your 32 and your 94. So that's what they report. But then they've restructured another 39 million, and 17 million is extend and pretend. So realistically, their delinquencies are rocking, or their stress is 49 million, 1.42%. But look at this. Granted, these will show up in delinquencies. 12.8 million, 20, that's what, 22 million shows up under there. So a lot of what is delinquent has been modified. But what is this? How do you have a modified loan on delinquency? You're not supposed to modify a delinquent loan. That's a big no-no. At least it was 25 years ago when I did this at Wells. So either they modified a delinquent loan or they modified it. All right, there's a 14.2. And it looks like they modified it right there, 13.14. And then the number drops to 7. But you see right there. So it entirely could be, I'm betting it is. I mean, this is not exactly rocket science. I'm basically saying that $13 million note, and this is a pool of loans. Some are in, some are out. But there's a pool, that's probably one note right there. And they modified it. And then it looks like the very next quarter, it went delinquent, which means it should have automatically been put on non-accrual, which means it should automatically showed up as non-performing right there. That would have been 38 million, but they didn't do it. So this is how you manage your delinquencies, by manipulating restructured debt. But in this instance, that 13 million went delinquent the very next quarter, and it looks like it's making payments. See, 13.14, 12.99. So it is late stage, it's early stage, 1 to 3 months, but he's not caught all the way back up. But he is making some payments. But I don't understand this. I don't understand why you would go through the process of charging off a bunch of things, but not cleaning up this aspect of the books. Are they doing a lot of extend and pretend across? Yeah, right? It's a gateway drug. Once you start doing it, you start doing it, and you do it more and more often. Owner occupied, you see the numbers starting to ramp up. C&I addresses, the number was ramping up, and now the numbers come down. How did it come down? They take charge-offs. Yep, they took a big charge-off. So it's possible that charge-off came from prior modified loans. But net-net, what you're looking at here is a considerable amount of delinquencies that are being avoided. $62 million. So they report 171 million, 1.5% delinquent. They restructured another 62 million. These guys right here are modified, delinquent, modified, non-accrual. They show up there. You can't add them. Adding them to that number would be duplicating it. But that number is separate. That's a whole nother separate basket. So realistically, this bank, even with all the charge-offs, they just recently took, and we're talking a ton, 35 million, which is way more than they've taken in a long, long time. Look at that charge-off rate going back. That's a lot of charge-offs, right? And so how much of it showed up as a REO? Not much. So they basically charged it off and they immediately sold those or dispossessed those assets. But even with that, the delinquencies are getting worse and worse and worse. It's only marginally better. So you took $35 million of charge-offs, but your troubled loans, your delinquencies plus your modifications only dropped 10. This is a portfolio that is getting worse. And I think you're going to see more acquisitions like this because that's why. I mean, credit is turning. That's the next problem. And I commented a little bit earlier, they're not reserved. This is a coverage ratio. So a couple years ago, they had $3-4 of reserves for every dollars of non-performing loans. And then the number got down into the 2.5. Then the number got down into the 1.5. And then the number got down into the 1. And it's low. Once again, this peer number is the smaller banks that shouldn't be these guys' peers because not all the bigger, but not everyone's filed. So you're getting a smaller mix of the early filers are typically smaller asset size banks. So that peer number is not a fair number, but they're considerably lower than what they've ever been. And when you add in the extend and pretend, this bank's not reserved. So I get why Atlantic Union, I get why Sandy Spring would sell. I'm hoping Atlantic Union was smart enough to understand and modify their purchase price for all this. But this is basically, how do they pay for all these losses, right? Because Atlantic Union is now bringing onto their books a deteriorating, not vast, but a portfolio that is getting worse every single quarter. Even though they dumped $35 million in charge-offs, it's still, right? It hardly went down because that buckets of trouble keep getting bigger and filling, but they don't have enough reserves. So realistically, it comes back to you got to fire a bunch of people, right? I don't know what the branch overlap of this is, if there's going to be a lot of branch closures, but assuredly one of the ways, and this is how the industry absorbs losses, people lose their job, right? Consumers get fewer choices because you potentially have less branches. Don't know that that's the case. I've not taken the time to look to see what the overlap is, but certainly a lot of headquarters people are going to subsidize these losses on underwriting. As always, I appreciate your time. If you have any questions, please reach out and give me a call. Thank you.